Well, ahead of tomorrow's Fed decision, we did get another reminder today of the challenges in central banks fighting inflation. Here in Canada, the inflation rate, for example, in August rose by more than expected for a second straight month. Some of that was higher gas prices, which may not faze the Bank of Canada, which recently held rates steady. But let's get some more perspective from Claire Fan, an economist with RBC. And Claire, it is interesting. The market today seems to be absorbing higher oil prices and maybe even the inflationary environment here in Canada as they gear up for that Fed decision on this idea of, do we need to be ready for higher inflation for longer and higher interest rates for longer? What's your take right now?
Yeah, so the inflation data for August this morning obviously was a step away from Bank of Canada's 2% inflation target that they're desperately trying to get to and maintain the inflation at these days. But, you know, it's not really the one report this morning, more so than the fact that, you know, core inflation, where some of the measures that the Bank of Canada uses, where focuses on to get a better understanding of the underlying price pressure here in Canada. They've been stuck at 3.5% to 4% range since late last year, and that to me is more concerning than one report alone. Obviously today, again, some of the core measures actually accelerated to closer to 4%. We're averaging around that versus, you know, their so-called super core measures have been sort of, again, at 4.3% on the 3-month basis. So it really is that persistent inflation pressure that we're more worried about these days. And to your point, you know, interest rates might have to go higher. That's still not our forecast. So overall, does it change our forecast for the bank to pause in October? No, it doesn't. But it does add more risk and uncertainty to that sort of scenario that the Bank of Canada would have to go again.
I guess the messaging is as important these days. We just had a speech by the Deputy Governor of the Bank of Canada saying that she is seeing evidence that higher rates is having an impact, but reiterating that policymakers are prepared to hike further if necessary. I mean, you wonder if you'll see similar messaging from Jay Powell and the Fed tomorrow.
Yeah, that's actually very interesting because to me personally, sort of the position of the Bank of Canada versus the Fed are very similar these days. So, you know, inflation rate, not exactly super high these days, around 3 to 4%, and obviously not back to target. So what they do, obviously, is they allow these central banks to take a step back and look at a fuller picture of not inflation, but other data as well. So the other data in Canada and the United States include labor market data. So in Canada, again, we saw unemployment rate increasing by 0.5% earlier in the summer. And some of the other measures as well on consumer spending are starting to show that broader aggregate demand is losing steam. So in Canada, what we have is inflation starting to pick up, but broader macro backdrop is deteriorating. So put those two pieces together. That allows the Bank of Canada to just say, hold on, just let's take a pause here and wait for more weakening in macroeconomic data to come through. And let's see if that can ultimately slow inflation back to target as well. And that's a good segue into the Fed because it's a very similar decision-making process, or thinking process. You know, it's quite the opposite. Their inflation is looking really good, but at the same time, consumer spending is incredibly strong. We're seeing some very strong retail spending data into Q3. So they're wondering, are low inflation readings sustainable? And then that's also allowing them to sort of hit a pause at this point. So it's kind of interesting how the same decision-making process allowed them, despite very contrary circumstances, to be on sort of making the same decision at this point.